Welcome to the Savvy Ladies Wednesday Wisdom webinar. I'm Maggie Montemuro and I'm the Marketing Manager at Savvy Ladies. If you have a question during the webinar, please type it into the chat box. If you're joining us by phone, you can email your question to info@savvyladies.org. Today's presenter is Moira Laidlaw, a highly accomplished attorney. Moira concentrates her practice in complex trust and estate planning, probate, elder law, Medicaid, special needs planning, guardianship, tax, and small business planning. Moira is a certified elder law attorney by the National Elder Law Foundation, as accredited by the American Bar Association. She is one of only about 400 attorneys in the U.S. who holds this designation. Moira takes great pride in counseling her clients during often difficult, sensitive situations, drawing on her deep legal knowledge and thoroughness to find a favorable outcome. Thanks for being with us today, Moira, and let's get started.
All right, and thank you so much for having me. All right, the lecture I'm going to give today is my favorite lecture to give because it is sort of this top 10 list of things that can really go awry for families, and by talking about it ahead of time, we can really head off some issues at the pass. So I'm going to quickly take you through the presentation. You know, this kind of just talks about the firm. I work at a 10-attorney firm. We have 3 office locations in this area. All right, of course, none of this is meant to be personal legal advice. Almost for every rule in the area of estate planning, tax, guardianship, Medicaid, there can be an exception to it. So I do mention here that we do give complimentary initial consultations, and take us up on that. And as you're potentially going to be sending questions in for me to address, just be sure not to put anything of a confidential nature there and keep the questions as generic as possible. All right, I'm going to skip my bio. And then that was an IRS rule where I have to tell you not to use trust to avoid paying income taxes. All right, so then in terms of a big picture, the way that these mistakes are made are really by people in our life who we are ordinarily very well guided by and supported by. They're friends and families. Sometimes they're like a local bank or investment advisor who just isn't quite giving you the advice that you need to receive. So the first mistake people make is failing to do any planning at all. That's really common. I would say, gosh, 4 out of 5 consults in my office are people who are doing their very first set of estate planning documents. These are my favorite engagements because what we can do ahead of time with a pen, a court can do later with a lot more dollar signs after it. I always say, like, a judge will do things with literally a gavel, a hammer, whereas the things that we do ahead of time with a pen are much cheaper and much easier for our families to navigate. So on slide 8, we have the New York Advanced Directives. And we have this schematic where I show you when they're effective, because some documents are effective immediately when we sign them. Others are effective only when we lose capacity or only upon death. And so really simple is a will, a last will and testament. If I go to our surrogate court in New York State and I ask them to declare a last will and testament to be valid, they require me to show them an original death certificate before they will even accept my petition. So a will is just a piece of paper until a surrogate court judge declares it to be a valid will, and that will never happen until a person passes away. So many times people feel like if they're the nominated executor for a parent in a will, and that parent's in the hospital, they think that they should have authority to handle that parent's affairs because of their status as being named as executor in a will. But remember that will is not a valid document until that person passes away. So you need a different legal document. So on the other side, on the first part, is this durable power of attorney. The durable power of attorney is a financially related document that we can sign ahead of time and name someone to act for us. The way that banks and other financial institutions interact with agents who act under a power of attorney, it is best if that power of attorney is effective immediately upon signing it, and then it continues to be effective if the person later loses capacity. So that's why it's called durable, because it endures if a person loses competency. If it were a non-durable POA, I have never in my career created one of these, it would lose effectiveness at the very moment when you need your loved ones to have authority. So it would have a major gap in that loss of competency. We wouldn't have anyone to act. And when that happens, usually because a person either never signed a power of attorney or because they signed a power of attorney that did not include enough power within it, the family member's only option at that point to be able to manage a person's affairs is to go to guardianship court. So that's the very first example of where a court will do with a hammer what we could have done with a pen. And there's lots of built-in protections in guardianship court because when a legal guardian is appointed for someone, that person loses the ability to manage their own affairs, to decide where they're living and who's going to care for them. So it's considered a major deprivation of civil rights. And attorneys are appointed to protect the person who's alleged to have lost capacity. All of that can be avoided with a really well-drafted, durable power of attorney. Okay, so then there are also springing powers of attorney, which seem really attractive because who wants to give all that power to someone ahead of time? But banks make it pretty difficult for agents to get springing powers of attorney honored by the financial institution. So although theoretically and conceptually that would be a great option, pragmatically we rarely ever recommend a client put in that it's not effective until the person loses capacity. All right, finally, we have healthcare proxies and living wills. In New Jersey and Connecticut, where I'm also licensed, those advanced directives with respect to healthcare wishes are done in one document, but in New York State, they're done in two documents. And that's because the right to name a healthcare agent came about by a state statute, enacted by our legislature. And then the right to set forth your end-of-life preferences for treatment came about from a series of case decisions. And so that's how we came to have a living will, which sets forth end-of-life preferences, and a healthcare proxy that names an agent. And I always say, doctors and hospitals, they really want to work with family and next of kin. And healthcare proxies and living wills are always drafted in a way that if the patient can make decisions, the patient remains in control. It's only when the patient is in the care of a doctor at a hospital or outside the hospital in the community, and the patient can't make decisions for himself or herself, that the agent then steps in. All right, and then finally, beneath these documents, and every New Yorker over the age of 18, every person over the age of 18 should have these documents: a power of attorney for financial matters, a will in case a person passes away, and a healthcare proxy, healthcare advance directive of some sort. What we layer onto these documents, which serve as the foundation for all estate planning engagements, are trusts. And trusts are really amazing because they are effective when you create them in your lifetime, and then they continue to be effective upon death. And they are governed by written trust agreements. And we can use trusts in my practice in all kinds of ways. Trusts can be their own full 30-minute lecture, so I'm not going to spend too much time at this juncture going into detail about trusts, because I want to get on to some of the more common mistakes before that. All right, mistake number 2 is adding a child on as a co-owner on a bank account. These are typically referred to as convenience accounts. What I want clients to do instead is use a power of attorney. And so if you have a bank account, especially, or if a parent of yours has a bank account and they need help paying bills and navigating some of the things as they age, it's always really tempting to just name one of your children who's closest to you to that account. But it really creates sibling issues upon death, because then that one child becomes the legal owner of that account by operation of law upon the death of the parent. And also, when you name a child on, they have ready access to that entire trust account, or bank account rather. And I've only once or twice had to do this, but I have had some children who've stolen the funds from their parents. But it really has to do more about sibling harmony on the death of that parent who passes away. All right, mistake number 3 is updating your will but not your designated beneficiary forms. And so, big picture, what people need to understand is that a will only governs certain of the assets that we own, but that there are other legal designations on certain of our assets, such that the will has no jurisdiction and no bearing on how those other assets are going to pass. So if you have a will, you have a probate asset. If you die without a will, you have an administration asset. Those are assets that are titled just to the decedent with no right of survivorship designation within any legal instrument. So if it's a financial account, it's a financial account titled just to the person who's passed away, and it wasn't held jointly with anyone. There's no payable on death designation and no transfer on death designation. If it's real property, it's a house or building titled again just to the decedent or held as a tenancy in common. Tenancy in commons are divisible interests in property that hold with them no rights of survivorship. Then there's tangible personal property. That's your stuff, your clothing, your jewelry, your rugs, things of that nature, furniture. That typically makes up someone's probate estate. And then business interests. Very often business interests are held entitled just to a person and not held jointly with rights of survivorship in any way. But then there's a whole class of assets that I refer to as non-probate assets, and they are not controlled by any estate proceeding. They are qualified retirement accounts. Those typically are IRAs, 401ks, 403bs. Any defined benefit plan will have a designated beneficiary. Life insurance. There are contracts with a life insurance company wherein you name a person to receive the proceeds of the insurance upon passing. Annuities. Annuities are contracts as well. Annuities can be a qualified retirement annuity or a non-qualified annuity. Regardless, they typically almost always have designated beneficiaries associated with them. The bank accounts that are not controlled by a will are any bank accounts held joint with rights of survivorship, payable on death, or transfer on death. And so that's the POD or the TOD. And then real property. There are tenancies by the entireties. Those are joint, those are deeds that are titled to a married couple. There's also joint tenancies with rights of survivorship. And then there's life estates that avoid probate. In a life estate, there's a person who retains a right to live in a real property for their whole life. But then upon death, it automatically passes to the people named as the owners subject to the life estate. And then there are, any other way that you can name an asset and designate a beneficiary, that's going to avoid probate. And so going back to trusts, when you create a trust agreement and you transfer assets over to the trustee of that trust, that's just another way of avoiding probate on that particular asset. All right, so moving to mistake number 4. That mistake is really straightforward. Doesn't require too much explanation. It's when a person names their estate as a beneficiary on a qualified retirement account. The IRS requires an ascertainable beneficiary to be named, and it has to be a person or a trust with very particular provisions within the trust agreement. If you name an estate, or if you name a person and a charity, the beneficiaries may owe all the income taxes within 5 years of the person's date of death. Whereas if you follow the ascertainable beneficiary rules, you're going to be able to stretch out the lifespan of that inherited IRA so that you're deferring and delaying when income taxes are owed on it. And big picture, if a decedent never paid income taxes on an asset that they held in their lifetime, even if there's no estate tax owed, the beneficiary of that account is still going to owe income taxes on that asset. And so this is all about delaying when those income taxes actually have to be payable to the IRS. All right, mistake number 5. Believing that life insurance and retirement accounts are not part of your taxable estate. This is really common. Very often people think that if they can avoid probate on how an asset passes, that they also escape estate taxation on that asset as well. And really nothing could be further from the truth. The IRS is smarter than that. And the IRS generally defines your taxable estate to be comprised of both your probate and your non-probate assets, with some exceptions, especially relating to trusts with no retained interest in the property transferred to trust. Oops, I went a little too quickly there. Sorry, let me get back to that slide. Okay, so then turning to what those estate tax exemptions are. In 2016, our federal exemption amount is $5.45 million per person. And there's a 40% tax levied on the amounts above that. New York State is trickier. New York State has a cliff tax. Our current exemption amount, as you can see, is just under $4.2 million. And April 1st of 2017, it will go up to 5.25 million. And then the law provides that in January 1 of 2019, they're going to match the federal exemption. So right now that federal exemption is 5.45 million, but it goes up a little bit each year because it's adjusted annually for inflation. The real problem with New York is the cliff component of it, because unlike the federal government, where you're just taxed on the amounts above the exemption amount, in New York, if you exceed this exemption amount by a certain small percentage, you go back and your estate experiences taxation from $1. So you essentially lose the entire exemption amount. So we have to do some real planning for our clients who hover near that range in terms of triggering that really punitive rule. So the next mistake relates to gifting and how gifts by people during their lifetime interact with that estate tax exemption. The most common misnomer in gifting is that my clients very commonly believe that they are limited to gifting $14,000 per year per person. Sometimes they think that amount is $8,000 or $10,000 or $12,000. It's presently $14,000 per year that the IRS lets us gift, free of any gift or estate tax implication to it. I call it our bonus or play money that the IRS gives us each year. But that doesn't mean we owe a tax if we gift more than that. And so I have this illustration where Mrs. Smith gifts $214,000 to her niece. And we're going to assume that Mrs. Smith is single and that the niece is single and that Mrs. Smith has never made a taxable gift before. And so all Mrs. Smith needs to do in this illustration is file a gift tax return to report the amount in excess of the annual exclusion. And the reason why she has to report it is because that extra $200,000 she gifted will bring down the exclusion amount from $5.45 million upon death in her estate to $5.25 million. So there's a dollar for dollar deduction from your available estate tax credit upon death. There's this dollar for dollar deduction between what you gift each year in your lifetime above that allowable $14,000 per person. And the other really common question I get asked on gifts is for the niece. Is that income taxable to the niece? And it's not. It's gifting and inheritance is a wonderful, wonderful thing to experience because it does not count as earned income. Any tax responsibilities rest with the person making the gift and the person receiving the gift, except in a few jurisdictions in our country, New Jersey being one of them, which levies an inheritance tax. The person receiving it doesn't owe any taxes on it. The real problem with gifting from a tax attorney perspective relates to cost basis. So if you give cash, the cost basis for cash is its face value. So it's not like I'm worried that if a client of mine is going to give $14,000 in cash, that there's any built-in capital gains in a cash gift. But most of the time, my clients do not want to give cash. They want to give stocks, or much more commonly, they want to gift their home in order to protect it, especially from nursing home costs. And so the real difference between being gifted an asset versus inheriting it is that when you are gifted it, you take over the original cost basis of the donor when you are given the asset in the donor's lifetime. Huge difference in an estate where you take over as your cost basis a date of death value on that asset, so that going forward, if you sell that asset after you inherit it, you only owe capital gains tax on the appreciation from the date of death value. And I have a slide that really makes this crystal clear. So if I am a recipient of a house and the person gives me that house in their lifetime, and that house originally cost that person $50,000 as their total cost basis, and I later sell that house, I'm going to owe capital gains tax on the gain above $50,000. Whereas if I inherit this same house, even the same house where this person still had that original cost basis of $50,000, but there's a fair market value of $750,000 upon death, then if I later sell it, I only pay gain on the amount above $750,000. Our capital gains tax, especially with the additional capital gains percentages that are levied through, our federal healthcare law, our capital gains tax federally and with New York State, and depending on our income brackets and all those, complex rules, it can be anywhere from, 20 to 30%. So think of that difference as you're thinking of gain on everything above 50,000 versus gain on just the amount above 750,000. And you can see in this illustration that hundreds of thousands of dollars can be saved with the right tax planning. And there are different ways to protect houses from nursing home care costs that still result in this date of death valuation upon the death of the person who passes away. And that actually serves as a good segue to mistake number 7, which is that thinking that Medicare is going to pay for long-term care. It's actually Medicaid that is the government benefit program which covers significant long-term care expenses. Medicaid eligibility is a poverty-based program, but especially in New York, we have an incredible judiciary who has been very protective of seniors' rights to voluntarily impoverish themselves. And that's really where we utilize trusts in our practice, is we create trust agreements to hold assets to shield and protect them from nursing home care costs or home care expenses with a home health aide. People often think that they will never qualify for Medicaid, especially because of their income. And I always reassure them that I work with families day in and day out, and we get them nearly immediately eligible for Medicaid. The rules have really complicated guidelines and traps for people who aren't familiar with them. But the actual public policy behind our New York Medicaid program is really incredible and very protective of seniors. Know that for nursing home benefits, there's a federal rule that all states have to follow, including New York, and that requires the states to impose a 5-year look-back period for any gifts. And that rule applies in New York only for nursing home care. It does not apply for home care. Most of my Medicaid applications on behalf of clients and their families are for home care. Occasionally we do nursing home applications, but most of my clients want to stay in their home as long as possible, and our New York Medicaid program will provide up to 24 hours of care a day. All right, so mistake number 8 really leads into my guardianship practice. And so that's leaving assets outright to legally incompetent beneficiaries. So I want to go over with you who are the legally incompetent beneficiaries. I don't remember if I have a slide on this one. I need to do a new one, but you can be legally incompetent in surprising ways. Minors are legally incompetent. If a grandmother names a grandchild who's a minor as a beneficiary on an IRA, that minor is not going to be able to collect that account. And that minor's parent will have to bring a property guardianship account to New York Surrogates Court in order to collect that asset. that account is then frozen by the surrogate court until that child becomes 18 years of age. And then that money is automatically turned over to that minor at 18. And then so too with any mentally incapacitated beneficiary. So they have no legal capacity, they're legally incompetent to collect an asset. And if a loved one names them as a direct beneficiary on an asset, a similar guardianship account will have to be created within surrogate's court. So we work a lot in our estate planning engagements to make sure that both the will and the designated beneficiary forms are not leaving assets to legally incompetent persons. And we're really problem solving around in order to get the money to those people, but in a much more fluid way that doesn't involve court involvement. Mistake number 9 relates to clients who create trusts but never transfer any assets over to the trust. So trusts are really easy to create, kind of in a mind-blowing way. You can create a trust by setting forth in writing who the trust creator is. In New York, we call them grantors. You're going to name in that trust agreement who the trustee is. That's the person managing the assets. And then there's the person who's going to be the beneficiary of the trust. And you can separate out who's going to receive income and versus principal. So let's say there's a grantor who gives a $100,000 account to a trustee. There could be a beneficiary of the interest income from that account and a separate beneficiary of the principal of that account. And then there can be one or multiple beneficiaries of those respective interests. And then upon the death of the last of them, we name remaindermen. That's when the trust ends and we pay the money out to the designated recipients at the end. And so a trust at heart is a relationship among all these people set forth in writing in a notarized instrument. So in New York State, to be valid, a trust has to be duly acknowledged, which means notarized. And so clients often want to use revocable trust to avoid probate in surrogate's court of assets. And the great thing about revocable trust is that we can immediately transfer assets upon death. The bad thing about revocable trust is that none of those assets are protected from nursing home costs. So we can also create irrevocable trusts. And irrevocable trusts are utilized in order to protect what's owned by the trustees from the person who created the trust from that person's healthcare costs. And then in my high net worth engagements, we're using irrevocable trusts to make sure that those assets aren't even part of a person's taxable estate. Trusts typically end with what's known as a Schedule A. And Schedule A is a living, breathing document where the trustee will note what was initially transferred to the trust and then update it over time as trust property is potentially added to the trust or taken away. Deeds to real property have to be changed and recorded with the local county in order to properly transfer a piece of real estate to a trust. So listing a house on Schedule A does not actually transfer the house to Schedule A. Schedule A is almost just like internal memo of what's in the trust or not in the trust. To actually transfer things, you need to retitle the interests themselves. So real property is governed by the deed. Bank accounts, you have to retitle the account with the financial institution. And then I have this, always when I talk about transferring money to trusts, I always want to reiterate that you never want to transfer a retirement account to any type of trust without consulting with a tax attorney. The IRS considers any retitling of a retirement account in a person's lifetime to be a distribution of the entire account as of the date of retitling. So you want to be really careful in not triggering a taxable distribution event there. All right, the final mistake occurs between spouses. Often they might come into me with a will they did way, way, way back when. It says everything to my spouse. I call them I love you wills, and I always say that they are a great expression of a marriage, but terrible tax planning. And that's because Our exemption amounts in New York, you either have to use them or lose them. So let's say I have a couple between them with $6 million in marital assets. I'm not sure if I have an illustration of this. They have $6 million in assets. What I want them to do is, on the death of the first spouse, I want them to tuck away some of those assets in a trust for the benefit of a surviving spouse. And in this trust, we give the surviving spouse total access to these assets, but they're not part of her taxable or his taxable estate if we draft the trust correctly. These trusts are often referred to as credit shelter trusts. I do them in a way where we use option 3 here, where we leave everything to the surviving spouse except that which the surviving spouse doesn't want. It's called a disclaimer trust. It's a really flexible estate tax plan. And it needs to be done ahead of time when both spouses are alive. This type of structure can't be created after the death of the first spouse. But just to reiterate, I do the complimentary initial consultation so that I have more time to meet with each family, talk about the issues that affect them, and explain whichever one of these issues might affect them in a lot more detail and slower than I've done. There's also some non-tax reasons for creating these types of trusts within people's wills, especially if there are any disabled children. You know, we can make the trust continue even to the next generation. And we can also protect these trust assets from the long-term care costs of the surviving spouse. So we're now utilizing these trusts and wills far more for long-term care planning, even for than for tax planning, especially as the tax exemption amounts get higher and higher. All right, so I knew it was going to be a quick one to get through all 10 of these in 30 minutes. So Maggie, I'm going to kind of open it up to any questions if anything's come through the line there.
Great, thanks, Moira. If you have questions now, just a reminder that you can type them into the chat or email info@savvyladies.org, and I'll read you the first question we have, which is, how much does a person need to have in assets in order for a trust to make sense to have?
That's actually a great question. You know, when I start talking about trust with my couple in their 90s with just a home and a small amount of savings, they'll look at me and think, oh, we really just thought that trusts were, for the super wealthy. I think that trusts benefit middle-class families the most. And then beyond, and that's because there's typically a fair amount of equity built up in a family home that we want to shelter from long-term care costs. And trusts are how we do that. There are some other oddball situations that, regardless of how much you have in assets, you really want to avoid probate. I had an estate once that I was appointed by the court to try to find the decedent's heirs at law. And I had to hire a genealogist because the decedent was an only child of 2 only children, and her parents were deceased and her grandparents were deceased. She had no aunts and uncles, no cousins, and all of her money went to New York State. But any estate that's going to be hard to locate the heirs at law, we want to use trusts because it becomes really expensive to get jurisdiction over hard to find heirs. But every situation is a little different. I would say even someone with 10 cents to their name really needs a power of attorney more than any other legal document out there, because guardianship court is so expensive. It's like a regressive tax the less money you have. So power of attorney is always my priority one, regardless of assets, and then trust will, and the usefulness of trust will really depend. I think
Okay,
that's mostly it. Yeah.
okay, thank you. And the next question here is, what if there are real estate properties in different states, such as New York and Florida? What's the best course of action?
That's a great question. A lot of the talk about trusts, especially avoiding probate and using revocable trust to do that, emanate from Florida and California, because Florida in particular has a very expensive probate court system that charges a percentage value of the assets being administered. Whereas in New York State, our maximum probate filing fee is just over $1,000. So big difference if you have a large estate. You absolutely want to avoid probate in Florida. And then the other thing I say is the only thing worse than one probate proceeding is 2 probate proceedings or 3 probate proceedings. And so real property has to be collected using authority from the home state's probate court for where the property is located. So let's say I have a New York resident who owns property in New York State and property in Florida. I would want to create a revocable trust, at least, maybe even an irrevocable one if we're worried about long-term care costs too. We create the trust, and at a minimum, we get the Florida deed retitled over to the trust so that we avoid that Florida percentage of the estate rule. We also avoid any court proceeding being required in Florida whatsoever. And then if we want to avoid a New York court proceeding as well, we retitle the New York deed to the trust in addition to that. So having real estate across state lines is definitely a flag in my initial consult for potentially recommending a trust.
All right, thank you. And the next question is, what is the amount a family should budget to set up instruments like this?
You know, that really varies significantly, but and part of why I do the complimentary consultation is I don't want people to have to worry about paying for anything before they get information. And then at the end of the consult, I can give a very precise quote on what it will cost to work with us. But I don't want to avoid the issue altogether. So I'm going to give you a little bit more price detail than that. In this area, you absolutely get what you pay for. And more really is more. So if I have a potential prospect who's calling and wants price info before, if they say, oh, but my attorney who helped me buy my house or condo said he could do this for me for $600, I'll say, yes, you're right. You could get a $600 will, but that's not going to get you very far in the scheme of things. And that's true especially for anyone with a union job. There's a union benefit for legal services that costs anywhere from $100 to $500. It's really, really too bare bones. And so when you work with a trust and estates attorney and you tackle this, you don't want to be penny wise and pound foolish here. You want the documents to be really robust to be able to respond to life going sideways. And life going sideways involves disability. It involves all kinds of complicated issues that you want the documents done ahead of time to be able to navigate those circumstances. So in general, every trust that I do has a cost of $3,500. Now, if I'm working with a married couple and we're doing mirror image trusts, I don't charge $7,000 for that. It's still a $3,500 fee for these marriage image trusts. And then for estate planning documents, there's like the will, the power of attorney, healthcare proxy, living will. There's typically a charge for a single person of $2,500 for those documents, and for a married couple, $3,500. It is a significant amount of extra work to do it for 2 versus 1, but it's not double the amount of work, which is why married couples get a little bit of a discount there and not a pure doubling. But yeah, that's generally the budget you want to have to work with. And just by comparison, if a person doesn't sign a power of attorney or the right power of attorney ahead of time, guardianship court costs around $15,000 to $20,000 to navigate. And so really good investment from the get-go, and not to mention the fact that you're then supervised by guardianship court the rest of that person's life, which has ongoing costs each year.
Okay, thanks, Maura. And did you have a last slide here with contact information? Do you want to just share that with everyone?
Oh, sure, yes. So I just wanted to thank everyone. This is our primary office in Mount Kisco, but as you can see from the kind of beginning slide here, we have an office across the street from Grand Central in Manhattan, where we regularly meet with clients, and then also an office in White Plains.
Okay, thank you. And we'll send all this information out to everyone as well. So I want to thank you, Maura, for a really great presentation. And I want to thank everyone who joined us today and hope you'll be joining us again. And thanks so much.
Bye now, thank you.
Bye-bye.